Hey everybody, welcome to Mortgage Today for Wednesday, July 5th, 2023. And oh, what a day it was. Yesterday, the markets were closed in observance of Independence Day, July 4th. So hopefully everybody had some fun and checked out a post from our sponsor at wellthatmakesense.com. Another one from Alex Hormozy talks about to take the first steps to success. You need to define your input and output variables so that you can get what you want and what you need. So you need to look at what do you want out of this equation or out of life or business venture, and what are you willing to put in. If those don't line up with each other, the key to translating theories into actionable success is know the input-output equation and what your fuel is going to be. So that's all about knowing your why and what you're willing to put in to get something out. So check it out on wellthatmakesense.com. On Wednesday, the bonds had a fairly uneventful overnight session with treasuries rallying modestly at the start of the European session and pushing back into weaker territory starting at 7 a.m. Eastern Time. Neither of the moves were significant in the big picture of bonds. Have been broadly flat since Thursday's data-driven sell-off, leading to an MBS being up 2 basis points early. Stocks were down 6 in the morning. Manufacturing contracted in June for the eighth consecutive month. According to the ISM manufacturing report, the weakness was across the board with new orders, production, prices, employment, all in contraction. Construction spending did rise by 0.9% month over month and 2.4% year over year to a seasonally adjusted annual rate of 1.93 trillion. Oh, that's a lot of money. Interestingly, residential construction was down over 11% year over year basis. Single family construction was down 11.6%. Multifamily was up 20%. Federal Reserve officials were less united in their June meeting than their unanimous decision suggested, as some favored interest rate increases but went along with the decision to leave policy unchanged. Almost all participants judged it appropriate or acceptable to maintain the target range of the Fed funds rate at 5.0 to 5.25%. Some participants indicated they favored raising the target rate range for the Fed funds rate 25 basis points at this meeting, or that they could have supported such a proposal. Officials supporting the rate hike cited tight labor market and relatively few signs of inflation slowing towards the 2% goal. Bonds sold somewhat abruptly on Wednesday with little by way of overt justification. While it's true that the Fed released minutes of its most recent meeting and there are no real revelations or no new ways to think about the points that have been hammered ad nauseum over the past few weeks, perhaps more important is the fact that the sell-off was largely over by the time the Fed minutes came out. Were traders bracing for impact? It's actually easier to imagine the sort of trepidation in advance of the next 2 days of economic data. After all, we know that the Fed wants to resume rate hikes and they're just trying to find a way to justify it. So at the end of the day, we're actually down 25 basis points, so down 1/4 of a point. Stocks lost about 9 points at 89.92. That pushes us down into this new range. So we have a whole new range that hasn't been touched on since mid-late May. So we'll have to see if the market decides that that is the new range for trading or if it's just a momentary blip. And that'll all be decided by the jobs reports that come out tomorrow and Friday.